is Bob Janjuah. He's Global Head of Tactical Asset Allocation at Nomura. He's going to be here throughout this first hour of the Pulse. And Bob, I'd like to start with some of the warnings that you've had from your latest research paper. I know that you've been speaking about monetary anarchy running riot. What do you mean by that?
Well, I guess, look, if we go back, what, three years now, QE was meant to be an emergency policy.
Yeah.
QE now and LTRO and all various versions now seem to be the norm. And, you know, my concern is that we're in an unfounded territory here, and we're treating it like normal policy. I think the key thing for me is when you blow up the monetary base the way we have done in Europe, the US, UK, there are going to be consequences for this. And such as inflation potentially down the road, or monetary inflation in particular.
But you know, a lot of economists are now saying, listen, we've not really reached a stage where inflation is going to be too much of a worry. I mean, yes, you know, that sort of possible threat of an oil price shock is always there, but you know, because economic activity hasn't picked up in so many parts of the developed world, there is still that sort of deflationary concern. Yeah.
Well, look, I mean, first of all, most of these economists didn't call the housing bubble, first of all. Secondly, yeah, there's a sort of economic truism, you know, money supply times money velocity ultimately gives you nominal growth. If the point of policy is to create growth, that's either going to require money velocity coming into the system or more M, right? If we get money velocity on a monetary base which is doubled or tripled, the inflationary output of that is something that we've never dealt with before, to be honest. So if they're successful, we have a problem. If they're unsuccessful in creating sustainable growth, then sort of what's the point?
So going forward, you look at the ECB's measures right here in Europe, for example, and it really has done, I mean, we've seen borrowing costs coming down for many of the countries that were deemed to be in trouble. We've seen increasing confidence in the markets, risk assets have seen a strong start to the year. Is this liquidity going to feed through to the banks and from them to the real economy?
I don't think what we've seen so far does much for the real economy. I think the LTRO1 took away a big tail risk, i.e. overnight bank collapse in Europe, which was a very real issue, I think, back in November. So that's worth something for markets. That's a good thing. But I think on an ongoing basis, the banks are still insolvent. They're undercapitalized. Governments are still running huge deficits without any real plans for growth or reform. And the private sector, frankly, you know, gets it. And I think the more the private sector looks at policies like we have at the moment, or policy settings we have at the moment, the more they try and offset that behaviour, to be honest.
How?
By spending less and saving more.
And that's basically a problem too.
Sure.
Because you have all this cash sitting on balance sheets.
Sure.
And if they actually spent and invested that money, I mean, it's UK budget day to day,
yep.
That would actually help kickstart the economy as well. You wouldn't need the government to step in so much.
Right, but there's a reason why companies are holding cash, right? If we go back to Japan in the 90s, companies sat on a huge amount of cash. Every 6 months or so, somebody called the beginning of a new bull market in Japan, driven by the cash balances in the corporate sector. The reason corporates hold on to cash balances is they lose confidence in the banking system, and they lose confidence in the whole financing setup. And ultimately, the other key thing here is that global final demand is not there to justify additional investment right now. We have global excess capacity. So companies are doing the right thing for them. Governments, I think,
how do you get that confidence back?
Well, you let assets reprice to where they go from weak hands to strong hands, ultimately. Right? That's what's meant to happen in a bear market, that weak holders of assets give up and the assets are transferred to strong hands. We're not letting that system, we're not letting that natural
consolidation, bankruptcy.
Whatever form of it is, right? We're just not letting that happen. Right? And we're sort of trying to pretend that we don't need to let that happen.
And we're going to talk now, Bob, about the first thing that you look at every morning when you get to work.
First thing I look at, well, Kevin Gaynor, unfortunately, he's always there, my partner in crime.
In the background.
Aside from that, the first chart I sort of really focused on is the gasoline price in the US. Key thing for us is that US consumer is income constrained, i.e. leverage is not there or they're not willing to lever up. So they eat what they kill. And in that context, food and energy prices, which Mr. Bernanke chooses to ignore when it comes to inflation, fair enough, they're acting like a tax on US consumption. And what we've seen over the last 3 or 4 years is there's a certain point where crude gasoline prices get to, and the economy, through consumer spending, tends to roll over.
When you say that this is something Bernanke ignores, what should he be doing? Because there are expectations now coming back for the prospect of more QE, so perhaps there is a response there to those concerns.
Well, look, I mean, QE2 created the bubble in commodity prices that burst last April, May, roughly. within which crude and food went through the roof. If you think back to Q1, Q2, US growth was very, very poor, driven primarily by the consumer not having any disposable income after paying for the gasoline and food. So I think more QE, I'm not sure if that makes any sense.
But that's probably not going to happen now.
I don't think we're going to get more QE in the US this side of the State of the Union address. But I think we may well end up with twist 2 in Q3 around the July meeting, particularly if our views on US rates also come through.
You're obviously focusing on inflationary pressures in the US, so how vulnerable are they to a potential oil price shock, which would also hurt, well, would impact not just inflation but growth as well?
Yeah. I guess, look, I think higher food and energy prices in the US, in a country where real wages have been flat for many, many years, nominal wages are flat, it's not really inflation, right? It's a tax on growth.
Yeah.
That's the real issue. So I think it's still very vulnerable. I think Europe is even more vulnerable. Europe has it's much less efficient when it comes to energy prices than the US. But I think 4.20, there's somewhere in that area for a gallon of gasoline is where the US consumer starts to really feel it.
Given that you think we should be in a bearish market, even if there has been some avoidance of that in terms of where asset prices are right now, what would you invest in? What you would go into? What, treasuries, the dollar?
Well, look, I mean, bearish market. Fine. Well, look, we got Q1 wrong. We spent too much time obsessing over the detail of LTRO rather than looking at it seeing it for what it was, which is $1 trillion of balance sheet. If we put Q1 to one side, I think going forward for Q2, we're looking for bond yields to sell off, to continue selling off, potentially 10-year yields in the US up to 275, 280. Which I think ultimately will cause some weakness in equity markets. So looking for perhaps, give or take, a 10% correction in equities from these levels over the course of Q2.
All right, on those Bank of England minutes just coming into us, budget deficit for February, almost twice as much as forecast. Forecast was for 8 billion, came in at 15.2, I think. So I suppose this really underscores the challenge ahead for George Osborne and this government. Yeah,
look, I think it's a tough one, right? I think the good things in the UK are that our banking reforms are a lot further down the road than most other countries, certainly better than Europe. And I would argue probably further down the road in some parts of the US, because UK banks are going to be Basel III compliant, ASAP. But I think beyond that, growth is clearly going to be an issue. I think, it is a problem. Austerity doesn't seem to be that popular. I would argue that what the UK's got is relative austerity. We're still running a big deficit, and it's a gradualist approach. I think we'll get there, but I think the people in charge are going to have to be very strong about following this path. I think selective tax cuts, fine, makes some sense, may generate a bit of confidence in the consumer, but I do think the debt issue is a very real issue, and I think we're going to have to focus on addressing that.
And I guess the worrying thing is that the consensus seems to be here in the UK that we literally have just begun on this road to austerity. It's going to get a lot more painful. Yeah, look, I mean,
I think anyone who pretends it's not going to be tough, I think is kidding themselves. I would highlight, though, that obviously the market understands this is the case in Europe, the UK. The market seems to believe that the US is not going to have to go through this sort of adjustment. It is. And I think the fiscal issue in the US is going to be a very real issue the day after the election. It will be a political issue into the election, but it's something they're going to have to address.
They're going to have to confront it.
You've got the mandatory cuts kicking in back end of this year.
But, Bob, we keep coming back to this issue, the fiscal issue, that the deficit needs to be tackled, but then we keep coming back to this problem of the effect that it's having on growth. Is the government here in the UK addressing that side of the equation? Well, there's no growth strategy, is there?
I think we're doing a slightly better job in the UK and the US than parts of Europe in that we are letting some asset prices adjust. But the reality is we're trying to have it all, right? We don't want taxes to go up, we don't want to have austerity, but we don't want asset prices to adjust. And you can't have all of that. Something's going to have to give. We're going to have to give across the board. I think there's still a tendency in the UK, in Europe, and the US to keep businesses and sectors alive that are value destroyers. And I would argue that the banking sector is one of those classic sectors that needs to be
But not if they comply to Basel III.
No, I think that the UK is further down the road, for sure. I think in Europe we've got a long way to go. And I would argue in the US as well, despite the fact that dividend payments are back, etc., that actually when it comes to Basel III, the US banks are way behind the curve there as well.